Okay, welcome everybody to another Pepperstone Learn It Live webinar. Tonight we're going to be taking a look at price action masterclass, so a bit of theory and a bit of live charts as well. And my name's Thomas Atkinson from FX Evolution, as always joined by Tyra and Bella.
Hi everyone, welcome to our masterclass edition of price action. One of the most important things that we talk about a lot. So looking forward to doing a little bit of theory tonight, but it is important to really understand what price action is doing.
Yeah, I'll be mixing in some of the charts so you can see what that theory looks like, because obviously the real world can sometimes be a little bit different to what we learn in the theory. And yes, this is definitely live, Aaron. Thanks for the question there. Okay, so just before we start, the risk warning as always, the information provided in these videos or this webinar has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. And of course, before doing any trading, you should potentially need to seek, if you need to seek professional financial advice if necessary before making any decisions. Okay, so what are we going to be covering today? So we'll be taking a look at a few things. First thing is going to be how support and resistance zones can work together, how to spot them, how to correctly, I feel, spot them. They are a bit subjective, so we'll take a look at some of the hard, fast rules that we use when looking for support resistance zones. How to then identify and trade potentially role reversal zones, so we're taking a look at that. How to identify channels and patterns, the all important patterns. We always mention that. We've got some great examples that have happened over the last couple of weeks for quite a few currencies and even gold. So we're taking a look at how to use patterns, more importantly in trend than even starting trends. So we'll take a look at that. And of course, how to look for the correct market conditions before using the strategy that we'll talk about tonight. And then as always, we'll have a Q&A session in the last 5 minutes of the webinar. So if you have questions during the webinar, please feel free to put them in the questions room. We'll either answer them as we go, if it pertains to what we're doing, or we'll try to answer them as best we can at the end. So hopefully everyone gets a lot of value out of tonight. So Tyrone, one of the things we always go on and on and on about, and I pretty much put it almost in every one of our slides, is, and I call it step one, and that is the top-down approach. So we'll actually jump into the charts and do a top-down approach. But the reason this is so important is many traders, even ones that have been quite experienced, don't necessarily look at the largest timeframes before making decisions. So you might want to be trading a 1 hour or 4 hour or daily, but many people don't look at the weekly and monthly. And that's just so important to do so, isn't it, Ty? I mean, you really need to know where the big money flow is at all times.
Yeah, otherwise you really are trading blindly. And if you don't really know what Big Brother is doing, and you could be longing or shorting smack bang into a serious support or resistance zone just purely because you haven't checked the chart. So yeah, the order of charts to check, especially if you're approaching a currency pair, with naked eyes, if you like. Look, it's different if you are just scalping, but you've done this once a week. I mean, that's all that's required. You only have to look at the weekly or the daily, a couple of times a week, if that, to know what the general direction is and to know where all the actual serious support and resistance zones are. So you don't have to do it for every trade. But if you are approaching a pair that you're seeing for the first time that you haven't got much recent history with, it is an absolute must to know what the bigger time frames are doing.
Martin actually mentions here signals are way stronger on the weekly and daily. And yes, of course, they really are a lot stronger. And that reason is because think of it as during a day, all of these things happen in the world. Then that day is compacted into multiple days during the week, which is 5 trading days. And then that makes a weekly candle. So when we think about it, all of those things that happened over that week make that one candle. And then they all go together to form potentially a trend that's been well thought out. And that's where that big money flow from likes of Goldman Sachs, JP Morgan, that's what they're doing. They're following money in and out of the market. And they can't just go buy, sell. They usually buy and hold positions for longer periods of time. So by following the weeklies and monthlies, you can get an idea of what the longer term trends are and then potentially take advantage of those on the smaller time frame. So first thing you want to do is start with the highest time frame you're looking at and work down. We want to then recognize a trending or range-bound market. We can do that quite easily by understanding things such as higher highs and higher lows, and also things such as channel patterns. we want to use lines, bars, and candle charts. So never fall into the trap of just using one. We're going to use line charts soon in the live charts to have a look at why they're a bit of an advantage over candles, at least initially. And of course, we like to use some of the major kind of currencies to start with. So before we do anything, let's talk about support and resistance, which pretty much makes up the essences of what's most important when it comes to price action trading. So here we've got a market. Now, because it's a bit of a masterclass, we will skip over some of the basics here, but we can see that effectively every time, let's think of this as price, every time price has reached this point, whatever that may be, it's been the sellers have basically gotten out of the market and the buyers have said, oh, this looks like value. And they've purchased it, they've purchased it, they've purchased it again. So when you see something like this happen, there's a chance that it may happen again. And because the market has a bit of a memory here, we can say this could be good value for us to potentially get in on this trade. So if we bought down here, then we could experience a bit of a bounce from this zone and obviously make some money from that. So how does this look like in candles? Here we have it. We've got our touch here, our second touch here, third touch here, and fourth touch here. You can see that once the first one was found to be support, the second one, third one, and fourth one had quite good trading opportunities in them with quite aggressive candles, things like engulfing candles here and engulfing candle here, and then probably on the smaller time frame or whatever time frame it may be, maybe a well thought out double bottom. A lot of different things could happen if we zoom in on that chart. So Ty, I think horizontal support is one of the best things for any trader really to get into when they start to learn price action. It's the simplest thing to put on the charts and to clearly see. Would you agree with that?
Oh, no question. And the thing is too, look, we have many traders who we work with who actually primarily just trade support and sell off resistance, and that's all they do. They ignore all other patterns. They just use price off support zones, and they're very successful at it. So yeah, realistically, it is one of the most important things. And if you are going to hone in on one particular skill and identifying serious levels, I probably couldn't recommend support and resistance more highly, because it is seriously of the order of importance, one of the most important things in any top-down analysis anyway, but most important when you're actually trading currencies.
Okay, so let's have a look at horizontal resistance. So similar to support, it's where basically price reaches a high. That high, maybe buyers are taking profits and getting out, and the sellers say, okay, I think this particular currency is overpriced, and they begin selling it down. So you can see the more times it happens, generally the more people that see it, and you get that kind of bounce effect that you want. And then of course you can trade that. So let's jump into the charts and have a look at the top-down approach. So here we've got a US dollar CAD monthly, and we can see I've got it on a line chart to get started with. Now, the reason I have it on a line chart is it just cleans up a lot of what we're looking at. You can see that there was those extreme lows on the monthly all the way down here back in 2006 and 2011. Now, while that doesn't matter right now, imagine if the chart was down here at this point, similar to where the pound is right now, pound US dollar, and we were looking at potentially selling right here. It may not be that smart to sell right here. If it breaks through, sure, but if you're selling here, you're basically selling into one of the strongest supports that's probably ever been on this currency. So you need to always look at these bigger time frames to make sure you're not in those zones. So here we can see the US dollar CAD on the side. Looks like the trend generally over the years has been up. It's having a bit of a breather here. We can also see that the all-time highs at this 160, it's kind of in the mid zone. This sometimes is what you see with currencies. So then what we like to do is we like to skip down to the weekly and then see what maybe has been happening over the last couple of years. So I think one thing that stands out to me straight away, Tyrone, and we're not necessarily covering trend lines that much tonight, but there is a pretty strong trend line on the weekly. And even on this take profit zone, it looks like this has been in play for a while here.
Yeah, definitely. And like I say, look, this may be a weekly, but these zones are important. Not so much, and you've got to understand as well, it's not even sometimes the level that you're looking at where you're expecting to potentially buy, but when the market is actually heading in a direction, it actually gives you a target to aim for. So it's not always just waiting for it to get there and buy off it. Like say, for instance, if we're looking at this USD CAD weekly now, and we get a moving average crossover, let's just say on the 20 and the 50, the red and the blue lines that we've got here, to the downside, and the price is currently where it is, the logical target is going to be this trend line at support. So it's a really good way to actually plan your trades out. So you don't necessarily have to wait for these zones. Once they've been identified, it's really, really important to use them as targets as well, because most of the time that's where the market is heading. Now, we've actually got a question that I might even just answer as we're moving here, because it is actually quite relevant. Yeah. So it's a question from Craig about understanding support and resistance, but not knowing how to enter off it, or just wanting some guidance around it. Look, tonight we are talking about price action as well. Okay, so as well as support and resistance.
I've actually got one on this.
We have. Okay. Well, maybe we can go straight to it, perhaps, and we'll explain.
Yep. We'll just jump down through the top-down approach, and then we'll get into that, because Craig does have a good question there. So here we've got the US dollar CAD, and the reason I wanted to bring this up is we usually on the daily we really like to put on, let's say, the candles and draw up our support resistance using the candles at this point. So I actually quite like the weekly and monthly to leave it as a line, and I'll leave those lines on my chart, maybe have a different color, and then I can always say, okay, that's a weekly, monthly support resistance. And then when you get down to the daily, skip over to the candle chart and start to recognize a few things. So one thing I recognized here quite quickly, Ty, with the US dollar CAD, was that if we went into the 4-hour and we zoomed out a little bit here, we can see that while the market's been going up off this really strong base, but more importantly, it's really following quite a nice little trend line. We're not covering trend lines hugely tonight. We kind of do expect people to have some idea of how to draw these lines, but what we have is a very strong trend up, and then we've got a really nice level of resistance up here. So further to Craig's question, in terms of trading support resistance, what you've got up here is a very strong level of resistance. So we can see, we'll highlight it, 1, 2, 3 touches. So 3 touches, it's failed to break through each time, and you can see that it's rejected. This is quite a nice little trend line that's going on here, Ty. Maybe the price comes back down and touches it again. But what happens if it breaks through this resistance? What are we thinking as traders? Is that significant to us as traders and potentially giving us maybe some kind of technical signal? I mean, Ty, do you want to break this down as well? What do you think of this one?
Sure. So, I mean, as we can see, we're obviously getting a lot of resistance at this zone. Now, what we're looking for, if we're looking to short this, for Craig's question, and that's what you're trying to do at resistance, of course, is we're looking for weakness in price. Okay, so the price action is going to be determined by what's happening on the most recent candles, but also what's happening, and we can see, we've circled these candles here, so we can see that every time the price gets up there, we're getting these massive rejection candles. Okay, so price is trying to get up, but it's closing well and truly below where it's actually getting to throughout that session. Now, we can add things like indicators. I mean, we'll throw on maybe a MACD indicator and a stochastic indicator on this one to see if we can get some more clues on it, because that is part of the process. Because what the indicators will do, we certainly don't trade just because of them, but what we are looking for is weakness and confirmed weakness from other sources. So as we can see here, classic MACD divergence. We can see that the 3 touches that we've got on the resistance zone on the USD CAD is clearly diverging negatively on the MACD. So as much as price is actually getting up there and rejecting, it's not being confirmed by the moving averages. Okay, so obviously very important side note that we've got significant weakness in these areas. So that's what we're looking for at these particular. So we're not going to try and short the resistance just because it's actually got there. We're looking for some form of proof. So MACD is one form of proof. What we're also looking for, so what we'll do now, we've highlighted this area. Let's just drop back to the 1 hour on the USD CAD, and we'll see if we can actually isolate a sequence of lower highs and lower lows, because that's what we're really looking for. And there we have it. Okay, so we'll actually draw our lightning bolt effect. We've got this every time, so we can see that right there, and we've got our peak up here. Okay, so you can see that prices are making lower highs and lower lows on the 1 hour. Okay, so obviously in a very significant zone. And this is why we're looking at the top-down approach, because we're looking for our entry points and our zones on the bigger time frame, but we're actually getting our entries on the smaller time frames like the 1 hour or sometimes the 4 hour. So Craig, when you're looking at this, and for all of you who are looking at wanting to get in on resistance and support zones, really the support and resistance is only the area or the zone, if you like, that you're actually looking for the entry. That isn't actually your designated entry point. What you're looking for is the price action on the smaller time frames to confirm that indeed that resistance is going to hold, or that support is going to hold price from going any further down and has reversed. So we're looking for these short-term trend changes. So hopefully everybody can see that. We can see, I mean, on the USD CAD 1 hour there, you can see that roll reversal zone. I mean, that was just typical, price action really. We've got higher highs and higher lows. It's come back and tested it. And hopefully in not too distant future, we're going to get a 2050 cross, which is really going to confirm that short.
But more importantly with price action is it's not just about being able to get in. If we were analyzing these charts, would we think that, let's say we were short here for whatever reason, would we think that it's going past this point? Not based on what we've seen. What we've seen is we've seen a series of trend line hits. We've then seen that the market is finding that as support. So it would be kind of stupid for us to think that this was going all the way down here, Tyrone, straight away, because what generally will happen with the market is it might do this, might bounce and then break through. We'll talk about that scenario, but also it's more likely to have a bit of problems here. So in terms of when you're trading in any market, you always want to have an idea of where your take profit's going to be, and price action generally gives us an ability to predict potential areas for us to trade into. So that's one of the things that Tyrone and I love so much about price action, is just in analyzing charts like this, you can see that not only do we have a plan of getting in, but we've also got stop losses. We could potentially place them above here, and we even have take profit areas.
It gives you everything you need, and that's the beautiful thing about them. They give you so many opportunities, not only to trade but also to target, and that's really, it's giving you the whole plan, which is exactly what most people in the market need, and that's probably what the majority of people who actually don't trade as successfully as they want to actually lack, which is actually a plan not only to get in but also to get out, positively or negatively.
Now, another thing that Craig mentioned, and I think this is why I brought up this one, is what if we saw the market do something like this, where we know the trend here, at least on this time frame, is pretty much to the upside, so it's going bullish. And we also saw in that weekly and monthly that while it's having a breather, overall, it's been US dollar fairly strong against the CAD. So if it did break through this zone here and then it came back down and tested, this would be what we call roll reversal. Now, we do assume a little bit in this webinar tonight that you understand the concept of roll reversal, but that's where basically resistance like this becomes support. And when this strong resistance is broken, because it's 1, 2, 3 touches, that generally means that the market has really thought about this area and it's ready to move on. It thinks that this is no longer an expensive price, but maybe easily a fair price, and it moves to its next area. If it breaks through and comes and tests this zone, this is kind of one of those higher probability technical analysis techniques where you get generally, I guess, probably better entries, Tyrone, and you also more likely not to have that kind of aggressive thing where you see a break, you take the break, it comes back against you, gives you maybe a bit of a heart attack when you're trading because you go, oh no, it's coming back, and you start to worry about your trade and you're not as confident in it. So one of these types of techniques, such as roll reversal, is really great for people that have been trading for a while or had just beginning, because there's a more chance of, or more likelihood, that this area is going to act as support, and there's going to be quite a lot of big, large buyers here. Do you want to comment on that, Ty? I mean, psychology is a big thing with price action.
Yeah, no question. And actually, it does lead a little bit into the into the question we've got here about how to identify potential false breakouts. So with that, with false breakouts, we are looking for those candles. I mean, so what we're seeing, well, even on that last attempted false, that was a false breakout there on that candle that broke that line, but actually pulled in. The best way to really identify a false breakout, if you like, is to wait for the confirmation close. This is the most important thing. So if a candle closes above that particular zone and closes above it solidly on the time frame, most importantly on the time frame that it appears the most clear, you have to take it on chance that that is going to be a break. If you want to be really, really conservative, what you want to be doing is actually waiting for it to break and then come back and retest it. That's the absolute ultimate conservative.
Which is that roll reversal. So
Yeah,
say it does
that's the
something
roll
like this.
reversal area.
Obviously, these are massive candles, but then it comes back down. This is our bearish candle. I know, a bit terrible drawing there,
That's
but
not too bad.
at this point here, we'd be looking at the safer, more conservative route where you've really seen that clear break, and this requires the patience. So you really need to be aware that if you don't see this kind of thing, if you see the breakout, you are sometimes going to miss them and they just keep going. I've actually got an example of that. We'll quickly just jump down to here. This is the pound yen. So we can see here, it's actually a pattern called a descending triangle, but we've got this really strong support that was broken. And sometimes this happens, it breaks through, as we can see here on the right-hand side, and there's lots of trade and opportunities inside the trend, but it never comes back in roll reversals. So what we'd ideally be looking for here is a breakthrough, come back, retest this area, and then short off. But of course it doesn't happen and just goes bang, 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 and starts selling off. And we have to look at other opportunities to get in the trade. But yes, if you want more conservative entry, it's in the roll reversal.
Yeah, and what we drew there also was, don't get us wrong, that candle formation that we drew and it broke that line, that's not what we consider a false breakout, okay? That's what we consider roll reversal. That's a breakout that we're expecting to come back and actually shoot up. So that is the actual perfect scenario for most of these. What we don't really want to see sometimes is a break that keeps going. One that comes back and tests the previous resistance that will now act as support is generally considered stronger. So don't think that was a false breakout. A false breakout is a candle that breaches the area but comes back and is unable to close above that area. Okay, so yeah, most important. And for those people here tonight who are having a little bit of trouble grasping price action, if you haven't already done so, we are giving away our price action module. So if you haven't done that one or haven't got the link for it, let me know in the chat window and I'll send you a free link to it, because it is one of the most important things when it comes to trading, and it will help explain a lot of how you get in and out of these support and resistance zones.
Okay, I'll just go back to this step 2. So hopefully everyone understands why we do the top-down approach, and if you can add that into whatever trading system you have, looking at the monthly, weekly really pays off, and obviously identifying strong support resistances really does pay off as well. So another thing that we feel is quite good for a lot of traders out there is to think about trading the 1 hour, 4 hour and daily charts. And we find that this is really good for people with busy lifestyles and also want to get into price action trading. So generally you should be able to find, let's say about 3 to 5 good opportunities per week within a selection of around 10 to 20 trading pairs. So that's your majors and your side pairs, those kind of things. Maybe some exotics, but we usually like to stick to those majors: US dollar, yen, odd USD, euro USD, etc. And you can always, of course, consider having a look at back testing your strategies using MetaTrader 4 or 5 or CTrader. And of course, you want to spend some time learning the way the market moves. So one of the reasons we say stick to a few currency pairs is because each one will react differently when you're trading them. So let's say you're a London trader and you come in maybe either early morning in London, or you're an Australian and you're trading when you get home from 9 to 5 kind of work, and you're trading those London opens. The pound and the euro are going to move quite a lot during those times because there's a decent amount of economic news coming out, whereas the yen may not trade anywhere near as much in terms of the US dollar yen until the US markets open or the Asian markets open. So it's important to understand also what you are trading and become an expert at that particular currency pair. Okay, so we had a bit of a talk about this before, Ty, and that's to do with required for long and short positions, where we're talking about a series of peaks and troughs and higher peaks and higher troughs. This is something that, as Tyrone mentioned in that price action module, that we cover quite a lot. So if you have the chance to get that and sign up, we'd suggest you get that, because this will teach you a lot about peaks and troughs and how to read the market effectively. So we won't go over that too much in tonight's webinar. So let's talk about combinations or channels, because as a price action based trader, we've probably all seen this before. We definitely know how to identify them, hopefully, being an intermediate webinar, but the importance of them is we really need a few different trading styles. So one of our trading styles is going to be based maybe around role reversal, and it's going to be based around following trends and getting involved in trends. But when we see a channel, what is it telling us about the market? It's basically telling us that the market is trapped within two zones. So here we've got the market trapped between the support and the resistance, and it's trading between those zones. And until it breaks past either way, so until it breaks to the high or until it breaks to the low, we really should be only considering trading with take profits and stop losses within this zone. So if we were to buy down here, let's say, so we've got the buy, where would we be setting take profits? Well, we might set them up here at the previous resistances, or potentially we could be setting it near the high of this resistance up here. And by doing that, we're really taking full advantage of the market. If we bought down here, watched our trade go all the way up here, and we've all experienced this, and then all the way back and break evenness, there's nothing more frustrating than that. So price action really gives us a great opportunity to find out where we should be setting take profits and where as well we could be placing stop losses. Because if you identify a quality channel like this and you're taking a buy here, there's no reason you couldn't place your stop loss a percentage behind this candle. So it's quite an effective way of trading as well, Ty. I think you're answering one of the questions, but that's okay. Hopefully that helps the person. So I think we're all probably pretty clear on channels. I just put it to the room. Is everyone fairly confident in channels, the way that they kind of formed and the way they trade them? Hopefully you guys are. If not, you really need to look into channels because it's a very important trading technique within price action. Okay, so let's talk about chart patterns and other types of chart patterns that we want to be looking at other than just channels. So channels will show us range bound markets and we can trade a different strategy potentially during those range bounds. But when it comes to these types of chart patterns, as in double bottoms, ascending triangles, inverse head and shoulders, and flags, a lot of people potentially use them the wrong way, or how we feel is potentially the wrong way. So they're using, let's say, inverse head and shoulders to get into the bottom of trends and the start of new trends, which as a theory is exactly what they are, just like double bottoms or double tops. But imagine if we use the power of these patterns within an overlying trend. So I'm actually going to jump out of that, have a look at the, I think it's gold Australian dollar daily. Now here we've got a chart and we can see that it's been on a very large bull run, quite a large move coming off the initial buys all the way down here in 2018. So the importance of this particular currency or this particular commodity here is what are we seeing within the trend? So here we've actually got a really nice inverse head and shoulders, which is in the direction of the trend. And look how powerful this inverse head and shoulders is. So we've got our left shoulder, we've got our head, and we've got our right shoulder. At the same time, we can see when the right shoulder was broken. Just after that, the cross of the moving averages goes back in the direction of the overall trend. And it goes for further than, of course, the head and shoulders. So the head and shoulders theoretical pattern should be generally showing us around this distance. So this is what we usually would expect. And it makes a lot of sense because we can see here what the expectation of this was to take it back into the previous highs. Makes a ton of sense, very good trading. But when you trade an inverse head and shoulders in the direction of the overall trend, it can get you into a trade where you might take, let's say, a percentage of your trade off. So you might take 20 or 50 or 75% of your trade off, and you are absolutely correct in considering leaving more of it on because trend is your friend. And when it's trading like this, it could potentially go even further, like is what happens. So you might have, like, let's say a trade here where you place it, you've got your stop loss. So let's say you get in on this candle here, you've got your stop loss of around what is that? Looks like probably about $39-ish, and your take profit could conceivably be all the way up here quite easily, which is hundreds and hundreds of dollars. So that's the power of kind of trading a pattern within a trend. So inverse head and shoulders, really, really important. But when you've also identified a longer term trend, you'll start to see other patterns appear in this trend. So here over this area, we've got an ascending triangle as well. So the ascending triangle happens within the trend, breaks through, and this is a great one, Ty, because not only does it break through and confirm, so here's our confirmation candle, but then we get that fabled role reversal where it comes down, it tests the previous highs right here, instantly bounces off that level and goes on to be a very successful trade. So it's not just, this is why we love identifying the bigger timeframes, because you can go down to the smaller timeframes in that trend and start to trade patterns in the trend. So powerful, isn't it, Ty?
This particular commodity has been, this is
Very
a
good.
technical analysis master. It's a masterclass of technical analysis since basically, well, pretty much since September of 2018, really. Like you got your even Adam double bottom that started the whole proceedings way back in November of 2018 in the direction of the trend after a higher high and higher low sequence on a daily chart. And it has not stopped since. It's given us so many serious entry points, like serious patterns here, like that, triangle. We've got the inverse head and shoulders, and that double bottom can't even be underestimated in October of 18 and November of 18, because that was in the direction of the trend. It's like
this
you've
would
got
be on a
three
smaller time frame as well. Really nice.
Absolutely. If you broke that down to a 4 hour, I'll guarantee there'll be a double bottom there, right on the 20 of the daily. So if you were trading this, you probably, I would be surprised if you had a losing trade. And the wins have been extraordinarily large. So yeah, that's what you're looking for. And this is exactly why we're looking for the momentum on the bigger time frames, because it opens up so many opportunities on the smaller time frames to actually get in and join in the existing trend. It makes a big difference.
Another reason you've got to love price action is that you can see here that the market's really having a massive breather on this particular commodity, which is gold odd. So we've got this really nice strong level of support. Now I draw the level of support here because this has wicked through and touched the 50, but you can see on the left hand side how many times it's supported on this zone. And then straight after it came back up, it went and tested this zone. So when you get a little bit better at reading the price action and support resistance, you'll notice that this is the very clear level. And you generally do also see that potentially on line charts. So if they've closed at these lows, you'll find a really clear level here as well. And if you do see that on a line chart, even stronger. So hopefully you get
just on that time frame, while we're there, just like while we are on this time frame, if you want to see an absolute classic example of there's that descending, there's the ascending triangle that we were basically talking about earlier on the bigger time frame. And look at the break of, you can see that it clearly rejected a few times, but then it came back, literally touched the zone perfectly, right on the 50 moving average, and happy days from there. Like that's just that's technical perfection, really. And I know a lot of traders that come to our webinars got into that. A lot of them were telling us as they were in there that they were very, very happy with that trade. So I'm really pleased that people were paying attention, and it really shows that when you have got your plans in place, all you really required there. You've got to remember that we don't advocate using pending orders to break a zone, but we absolutely are quite happy with them to retest a zone. So once a level is broken, you can put a pending order in as a role reversal area, because the first touch is enough to actually get the trade going. So that's why a lot of people got that, because it did happen at an obscure hour, but it was very well worth it.
So hopefully everyone is getting a bit of the idea of, it's not just about reading the theory and saying, okay, when we're doing price action, we're always going to look for head and shoulders, and we're always going to look for ascending triangles and flags. It's about thinking about it from another level. And that level is, what are the larger timeframes doing? If I see an inverse head and shoulders or an ascending triangle or any of those things in the direction that the larger timeframes are going, is that more powerful or less powerful? And generally the answer is going to be, it's going to be more powerful. And that's really what I think a lot of you hopefully get out of tonight's webinar, is thinking about it from not just the theory, but also the practical application of a lot of these things. So yeah, the gold odd, very, very nice.
Definitely. Just I've got a few questions about live market analysis. Look, we're going to be doing that in the webinar after this one. So in half an hour's time, we're actually doing another webinar on the live market analysis, the current markets. So if you're actually interested in joining, I know a lot of you are already subscribed, but I'm going to pop the link in the window here. So for anybody who would like to join our webinar in half an hour, we're going to analyze the live markets and pretty much talk about a lot of what we've discussed tonight, but in the actual markets that we can see now, and potentially isolate some trading opportunities. So feel free to join us on that link that I've put in the chat window.
Okay, so another thing, role reversal. Obviously, we spoke about this quite a few times. Everyone hopefully is aware of it, where resistance becomes support or support becomes resistance. We use this slide quite regularly. This is just a 4-hour, but it can be a 15-minute, can be a daily, can be any time frame. And we can see very similar to what we were seeing on that US dollar CAD, quite a few touches. So here we've got the 1, 2, 3, and actually a fourth touch, and then it comes back down, breaks through eventually, and then that resistance, which was currently what was seen as an overpriced maybe point, is now becomes a well-priced point. And that's just the nature of human psychology and also prices fluctuating within the markets. The markets are always evolving to what they think fair price is. I mean, in the 90s, probably things like Commonwealth Bank and Australian share was probably $4 a share, and now it's $75 a share. So things will go up. In currency, it's more about what the central banks are doing. So at any point in time, you will have a fair value, and when it breaks through, generally the fair value changes. And that's what we're trying to trade. So let's have a look at role reversal in a trend and what it might look like. So here's just an example of where support is broken in a downtrend, and then that support becomes resistance, and then that support becomes resistance, and on and on. Now, one thing you want to do as a price action trader is you want to notice what are the candles doing when they interact with this zone. So here we've got this really nice rejection candle that happens here, very, very important. And here we've got a beautiful engulfing candle that comes off that. And that's really important. When you see those types of things within the role reversal, it adds value to them. You can say, okay, rejection, the market is clearly showing me quite a lot of weakness here. I'm interested in this. And this is a very strong signal as well of weakness in the market. So that's what we want to be looking for when we're trading price action on the way down or the way up with role reversal.
When you see these sorts of patterns happen in the markets, they are a beautiful thing because they give you very, very clear points to get in and out. So especially when they're coupled to a couple of moving averages. So really look out for those because it happens a lot more than you think.
Yeah, it really does. And it's role reversal, we can't stress it enough. Great thing to base a lot of your maybe non-indicator price action clean based trading on. Okay, optimizing your entry. So something we had a question about before and we answered it hopefully. So we want to enter based on confirmation, not on gut feeling. And that really means that you want to be entering on confirmation candles. And if you're not confident in the confirmation of the candle, maybe wait for the role reversal back down after the breakout. We also want to potentially not break even our trades with fixed pip amounts. We go on and on about this, but it's because it's a bit of a rookie mistake in the trading field. We all like to have like 15 pip break even points. Tyron and I were no different. That's something we used to do many, many years ago. I do remember, I can't, what was it? Was it 10 pips or 15 pips or something like that, Ty? We had the 15
quite
pip
often,
break even rule.
what we used to do, we used to have a standard $100 stop loss, which was about 10 or 11 pips actually.
Yeah.
So that's what we basically did every single time, and we watched the money just float away.
Yeah, that was a bad idea. So probably don't do that.
Yeah, and just so you know, actually, and don't take us wrong. We don't mean you can't have a fixed money stop. Like say for instance, you had a $10,000 account and $100 was going to be your amount that you wanted to trade, which is 1%. That's perfectly fine, but don't let the pips determine that $100. So don't just trade a standard contract because that's what $100 is. Put the stop loss where it needs to be, whether that's 20 pips, 30 pips, 50 pips, whatever that is, and then work the contract size back for that. Okay, so it's fine to risk $100, but you might be trading 0.2 of a contract or maybe even 0.1 of a contract because your stop loss needs to be 100 pips away or 50 pips away. So always work out the pips and then adjust your contract size to that. Pepperstone have got some fantastic tools to help you do that. They've got the risk calculator and the lot calculator in the smart tools. So anybody who hasn't got that, just contact your Pepperstone support personnel, and they'll hook you up with their smart tools, and that works it out for you. So you basically type in your pip amount. So if it's 30 pips and you want to risk a set dollar amount or a set percentage amount of your account, and it'll tell you exactly what lot size to trade. So you really don't have to work any of it out. Okay, but most important, don't just make it $100 and say, I want to trade a standard contract, and that's that. The stop loss needs to be where the stop loss needs to be, not where you want it to be. And that's really, really important.
When it comes to price action or any trading, we always want to try to target higher R multiples. It goes without saying, the more profit we make with the smaller stop loss, the better it is. That being said, you've got to be realistic with your stop losses. So you've got to put them behind either the lowest low or the previous kind of swing or something like that. You really need to think about it. Price action gives you some great stop loss levels. So think about in those role reversal zones, if we see an engulfing candle, where would we potentially be placing our stop loss? It'd probably be behind the candles. Now, if we didn't see that, but we want to be involved, we may need to look to the last swing and place our stop loss. So price action will help us with our stop losses. It'll also help us with those take profits, and we want to try to aim for over one-to-one trades. I've seen a lot of guys that might have 70, 80% win rates, or what they think is 70 to 80%, but they're only taking 0.6 to 1 of profit to loss, so, or even worse, so they might be taking 0.2 to 1. Generally speaking, that's not really a great strategy long term. If you're following trend, and that's what you're starting to do with price action, you can see with those inverse head and shoulders and ascending triangle on gold before, you can really get over one-to-one trades within trend and do very, very well there. So we think practicing discipline and waiting for those trades, well worth it. And of course, with practicing discipline, which is a little bit boring, but it's the right thing to do, you want to also sometimes have to give up good looking trades, because if they don't meet your criteria or your trading system, then you just have to let it go. Don't go on that gut feeling if you can help it.
You only use your gut feeling when you're like getting married and stuff. There's no place for gut feelings in the market. The minute you start doing that, you're in all sorts of trouble. You've got to have proof. Okay, don't. The minute you let emotion get involved, it's the first thing that it's a self-destruction mechanism of all traders when they let emotion get involved in their trading decisions. You've got to go. Technical analysis is all about history repeating itself and waiting for that quality. So keep your emotions at the door when you approach your trading computer, and the rest of it will take care of itself, because the market gives you the signals.
I think you need to tell people at house auctions about keeping their emotions under control, Ty. Some of them get wild. All right. So with having your trading system, you want to have multiple entry criteria, as we always mentioned. I think a lot of beginner traders or novice traders will use maybe one or two reasons. You actually want to have quite a few. So some of them that you could use, potentially things like moving average crosses, support resistance, should always be in there in our opinion, very, very important. Candle confirmation is great, Fibonacci retracement is great, MACD, stochastic, Bollinger indicators. With indicators, try to make sure if you use them that they're not ones that just agree with each other. So sometimes it's good to be educated in lots of indicators, but if you're going to have, let's say, a stochastic and an RSI up on the screen, you'll often find that they give similar results.
For all of you who have done the foundations course, like you already know this, but it's really, really important to use indicators that are deriving their signals from totally different sources. Okay, so MACD divergence is completely different to what Bollinger Bands are telling you about volatility, and what the smoothing of moving averages is telling you about what the price action is doing, and of course the stochastic. So it's really, really important not to overlap like indicators that are really telling you the same thing, because you're not really getting any new information by using 5 indicators that are basically all going to always agree with them with each other, because it does happen, and we've seen it. Like we've trained plenty of people where their indicators are so full on their screen you can't even see price, and all the indicators ironically are all saying the same thing, which is not what you really want. You want multiple indicators that are telling you from very different sources why something could be signaling a move up or down.
Okay, well, if anyone has any questions, please ask them now because we've got a few more minutes to answer those questions. We're getting near the end of the webinar. But one thing I want to mention is in our course, obviously, we have our Pressix system, which is our business plan effectively. In the previous business plan or this points-based system, we've just set a mandate for 75 points before placing a trade, so at least having 3 reasons. But in the Pressix system that we've set up, or any system that you may set up in the future, you want a really well thought out concept of how to place a trade, how to get into a trade, and usually use a bit of everything. So these letters actually stand for using different things to get into a trade, and we actually like to use one from each one of these letters before placing our trade. Now, Tyron, we've actually got a 25% off coupon at the moment that's available for people. We don't usually do this type of thing, but we do have it for the Pepperstone guys. So if anyone's interested in having a look at our courses, we don't usually look at plugging them, but you can jump over to fxevolution.com and consider having a look at those. And we think probably improving your trading journey.
The price action module that nearly everybody has done now, and I've sent it out to nearly everyone who's requested it. If anyone else, I've actually put it in the main chat window, so anyone's welcome to click on that and
awesome.
Do it for free. That's actually the P, obviously, the price action module. Each module represents one of these letters, and this system actually calculates a score and gives you a ranking of that trade. So it's a really unique system, and I think we're going to do one in the coming weeks just on how to use the Pressix system and how to actually apply it in the live market. So for anyone interested in that, yeah, you can join our webinars. But we are, like I said, we're going live again in about 15 minutes. So for those of you who haven't seen the link, it's in the chat window, so you can click on that, come to our webinar, and we're going to do a lot of what we've done today, but obviously in the live markets, and see if we can isolate the support and resistance and the price action that we've been looking for. I think there are a couple of really good examples in it tonight, actually. So
I think you've answered a lot of the questions that came through tonight, Ty. And we do need to get into the other webinar as well and get ready for that. So thank you very much for attending. Hopefully everyone got a couple of good little tidbits out of that one. I think the things that I would get out of tonight's webinar would be top-down approach. We go on and on and on about it, but really add that into your analysis if possible. And I think also it's worthwhile noting that things like role reversal are really, really powerful with not just only finding good places to be in the trade, but you've got to think of when something's coming back and it's testing those previous peaks or previous troughs. Generally speaking, if you place a trade in that zone, there'll be a high chance that at some point your trade may go into profit. And that should help you as well from a psychology standpoint, because no one likes seeing their trades go negative, and taking the conservative entry always means that you're less kind of swingy and therefore less susceptible to taking your trade out early and getting a bit upset with yourself about it and seeing things go backwards. No one likes that one.
All right, guys, thank you very much for joining us. We will see you all again in 2 weeks' time. You'll get your invites from Pepperstone for that webinar, and don't forget to send any feedback to your Pepperstone representatives. If you have any ideas, or if you've got any things that you'd like us to cover in future webinars, they're always looking for suggestions because this is all about you guys. We want to make this as user specific as possible. So any ideas you'd like us to cover, let your Pepperstone representatives know, and we'll try and include them all in the up and coming webinars.
All right, guys, see you in 2 weeks' time, and thank you very much for attending. See ya.
Thanks for joining us, guys. Good night.